If you had $1 million invested in Dividend stocks right now, how much monthly income would you actually get? Close your eyes and take a guess. Is it $10,000 a month? Is it $5,000? Or maybe it's closer to $2,000. Most people see that seven-figure balance and assume they are automatically set for a life of luxury. But the real number is completely different from what the internet wants you to believe. The gap between expectation and reality is exactly why so many investors fail to reach financial independence. Today, we are stripping away the hype and looking at the cold, hard math of a dividend income strategy. You are going to learn the actual income you can expect from $1 million portfolio, 3 distinct scenarios ranging from ultra safe to high risk, and the one catastrophic mistake that wipes out most dividend investors before they ever reach the finish line. By the end of this, you'll see that one of these portfolios pays almost double the income of the others, but as you'll see, that extra cash comes with a hidden price tag that could ruin your retirement. The idea of living off dividends with $1 million is the ultimate financial freedom dream. You've seen the headlines. You've seen the social media influencers claiming you can retire on a beach with just a few clicks. The common assumption is simple math. If you find a stock with a 10% yield, you make $100,000 a year. If you find an 8% yield, that's $80,000 a year. It sounds perfect. It sounds easy. But there is a massive problem with this logic. Those high yields are usually unsustainable, and chasing them is the fastest way to turn $1 million into $500,000. So what actually happens when you invest $1 million for dividends in the real world? To understand the income, we first have to understand the reality of dividend yields. In the stock market, you generally get what you pay for. If you look at the S&P 500, the average dividend yield typically hovers between 1.5% and 2%. If you move into dedicated dividend ETFs, you might see yields between 2% and 4%. Once you cross into high dividend territory, looking at 4% to 6%, you are entering a different level of risk. The golden rule of dividend investing is that a higher yield almost always equals higher risk. When a yield gets too high, it's often because the stock price has crashed or the company is struggling to stay afloat. Dividend cuts are real and they are painful. Business instability is the enemy of passive income. So with realistic yields in mind, let's look at what the income from $1 million actually looks like across 3 different lifestyles. Scenario number 1 is the safe dividend portfolio. This is for the conservative investor who values sleep more than a massive monthly check. This portfolio focuses heavily on dividend growth, investing in companies that don't just pay a dividend, but increase it every single year for decades. We're talking about dividend aristocrats and large, stable companies with massive moats. Think of companies that provide the electricity to your house or the food in your pantry. You might also hold broad market dividend ETFs that prioritize quality over quantity. The yield on a portfolio like this is typically around 2.5%. Let's do the math. $1 million multiplied by a 2.5% yield equals $25,000 per year. When you break that down, your monthly income is approximately $2,080. For many people, this is a shock. You saved $1 million just to make $2,000 a month. That's barely enough to cover rent in many major cities. The key insight here is that safe dividends produce far less immediate income than people expect. However, the trade-off is that your principal is likely to grow, and your income will likely outpace inflation over time. But what if you need more income to survive? That brings us to scenario number 2, the balanced dividend portfolio. This is the middle ground strategy that most seasoned investors aim for. Instead of just picking the safest companies, you mix in some high dividend blue chip stocks and perhaps some real estate investment trusts, also known as REITs. You might hold a mix of high quality dividend ETFs that target a slightly higher payout. In this scenario, we are aiming for an average yield of about 4%. The math here looks a bit more promising. $1 million at a 4% yield gives you $40,000 a year. That breaks down to about $3,333 per month. Now we're talking. This is a respectable middle-class income in many parts of the world. It covers the essentials and perhaps a few luxuries. But the trade-off is that you are taking on slightly more risk. These companies might not grow their dividends as fast as the safe group, and their stock prices might be a bit more volatile during a market downturn. But for many, this is the Goldilocks zone of passive income with dividends. But even $3,300 a month might not feel like enough for someone who has worked their whole life to save $1 million. This leads people to the third and most dangerous scenario. Scenario number 3 is the high yield portfolio. This is the aggressive dividend strategy. To get the yield up, an investor might look at BDCs, which are business development companies, or specialized covered call ETFs, and high yield funds that use leverage or complex option strategies to manufacture income. In this world, an average yield of 7% to 8% is the target. If you hit a 7% yield on $1 million, your annual income jumps to $70,000. That is a monthly check of $5,833. On paper, this looks like the winner. Who wouldn't want nearly $6,000 a month? But this is where many dividend investors get into serious trouble. High yield investing is often a trap. When a fund or a company pays out 8% or more, they are often returning your own capital to you, or they are failing to reinvest in their own growth. This often leads to capital decline. You might be getting $5,000 a month in dividends, but your $1 million principal might be shrinking to $900,000, then $800,000. If the stock price drops faster than the dividend pays out, you aren't actually making money. You're just slowly liquidating your account. This leads us to the biggest dividend investing mistake: yield chasing. This happens when an investor looks only at the percentage yield and ignores everything else. They ignore dividend growth, they ignore business fundamentals, and most importantly, they ignore total return. Imagine buying a stock because it has a 10% yield. You think you're a genius, but then the company hits a rough patch and cuts the dividend by 50%. Suddenly, your income is gone. Even worse, the market reacts to the news and the stock price crashes by 30%. Now, you have less income and less wealth. High yield today often means lower income tomorrow. You have to look at the health of the company, not just the size of the check. So what do the smartest investors actually do? They don't just look at dividends in a vacuum, they focus on a total return approach. This strategy combines the power of dividend income with capital growth. Instead of trying to squeeze every penny out of a dividend yield, they invest in a mix of dividend growth stocks and broad index funds. They might only take a 3% or 4% withdrawal from the portfolio each year, regardless of whether that money comes from a dividend check or selling a few shares of a stock that has increased in value. $1 million portfolios earn $40,000 per year at 4%. This is sustainable since the stock market traditionally grows at a rate that lets you withdraw 4% while the balance grows. This prevents inflation and money shortages. The lesson is that dividends are not the sole strategy. They are a tool, not the whole kit. Summarizing the 3 realities of $1 million portfolio clarifies: a safe portfolio earns $2,000 monthly. Balanced portfolios pay $3,300 each month. A high-yield portfolio might earn nearly $5,800 a month, but your wealth could go. While $1 million can offer life-changing income, it rarely creates the huge, effortless wealth that many expect when they start out. Building a dividend income strategy takes time, quality, and a realization that financial markets are not free. Accept more risk for a higher check. Accept a smaller check for safety. The key to winning this game is selecting a yield you can bank on for 30 years, not the highest. You're not alone if you think $2,000 or $3,000 a month isn't enough to live your dream life. We must pose a bigger question. How much money do you need to get $5,000 a month in dividends without losing your principal if $1 million only provides you $3,000? Answering that question typically wakes up investors and affects their course. In our next deep dive into the $2,000 a month dividend approach and beyond, we'll explain how to bridge that gap and construct a $5,000 engine. Let the numbers motivate you to plan better.